Good morning. This is Vance out of the Seattle area. It's Tuesday, May 24th, 2016. This is the second week that we've seen kind of carry over into this little bit of uncertainty. Part of that's caused by the markets weren't thinking at all that the Fed was going to raise rates, and they've been coming out talking like, well, you know what, we might do it as early as next month. And so, I mean, the market's certainly moving that direction with respect to our reserve currencies, the euro and the dollar. But I think there still is some increased uncertainty. Also, the stocks have been, recently the banks have been taking profits ahead of summer, that sort of thing. So this is all kind of, easy to anticipate. But the dollar overall continues to be a little bit bullish because of the Fed, and the pound continues to be bullish as well against the dollar because more and more it's looking like the UK breaking from the Eurozone partnership is unlikely. They call that the Brexit. So, not a lot more than that, actually. As you know, or you may not know, the fundamental sentiment that I cover is a continuation. So if you follow this, let's say for 4, 5, 6 days, you'll have a picture of fundamental sentiment. But if you hop on one day, I might just say what I said, and it doesn't sound like I'm saying much. So there's kind of an ongoing story, and all I do is just continue with chapter 2, chapter 3, and that sort of thing. All right, so let's look at price. One of the things you'll notice here, and let me see, what time was that? Just around London Open, they came through this level right here, and I've got this mark. You guys know I don't call these trend lines. Trend lines are a symbol, and it's kind of advanced thought, but most of what you're going to see in Forex trading are symbols, and symbols actually represent something else. So they're kind of a shadow of information. And a lot of the symbols that you see in Forex trading are really poor representatives of the actual information. But what a trend line really is it's showing you where the buyers and sellers reconciled at 50-50 interest. And here, on the 19th at 9 o'clock, it was right here. And that's over a 30-minute period. So it's billions of dollars changing hands. And then later on the 23rd, much farther along, as they came down and reached towards this level, they reconciled a little bit higher. And that created this, what you might call this waning interest on the part of the sellers. And so what this does is this creates what I call a timeline. It's really more of a timeline for measuring buyer and seller interest over time, so that you can see how this is shaping up. So what we look for, and what you'll see me doing over and over again, is I'll look for a change. And so as price was coming in here again, got close and bounced, I would have been looking for a change. And I've noticed over thousands of observations that you can actually drop to a 5-minute and look for a change there. So what I would have been looking for had I been here at this time is I would have dropped down to the 5-minute right here, and I would have watched how price. First, I would have checked to make sure that reconciliation levels were the same. We need to drop this down just a tad right there, and it shows that's the key 50-50 level. And so what I would have been looking for is this. This is a change. This is something. It's the 24th, and this candle close right here represents a change going all the way back to the 19th. And so that would have shown me, this would have said, no, buyers, the orders are still there. But when this happened, that would have shown me, you know what, price is likely to drop. Now, at that point, there's a couple of things you can do. If it's indecisive, it's going to float back up here again, even though it's likely to go down. If it's very clear and strong, it's less likely to entertain buyers in this area. But there are a couple of things you can do. You'll see me very often just go ahead. If all the risk assessment is all good, you'll see me selling almost immediately when you get the proper close in this area. Then I'm usually targeting something like 9 to 10. And here we would have just squeaked it out I no, we would have gotten in. We would have waited because the uncertainty gotten in about right here, and we could have squeaked out 9. I'm not sure if you can't, unless you're in real time. You can't really do a great job of assessing. You can't look back and really assess all the factors. Not really. It might seem like you can. So I'm saying that more than likely I would not have taken this trade, but I wasn't here. So I couldn't tell you for sure. Now, if you look at my book, Forex Legacy, you'll see leading up to your ability to simply see buyer or seller advantage and risk assessment and that sort of thing, risk management. Prior to being able to do some very simple, very advanced moves, you have to learn to walk before you can run. And one of the things I show you there is to look for a push, pullback, second push, because this is the most common pattern in Forex trading. And then you get used to a pattern which really isn't push, pullback, and second move. What it really is you getting your eyes tuning into buyer or seller advantage, strength of advantage, and then how do I manage the risk? And you do it in a very good way. Later on, what I do, which is just boom, 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 looks really simple. That actually involves a lot of experience, but you got to work your way up. So what we would look for is as you see this take off here and then pull back, we would look for a minimum range of advance. That means how strong is the move of 18. We only have 12. The next one that comes in at 12 as well. And so in terms of that trading style, these moves are not strong enough, and that only confirms the idea that there's indecision out there. There's a lot of, instead of just straight selling in this area, there's also still a lot of interested buyers. I would say we're going to continue with the US dollar sentiment, and the reason why is simple. If we go back to a weekly chart, basically the name of the Fed game here is stability. And if you look, we just visited the top of essentially the price range going back to 2000, what month? May, basically a year. We're in this range, and you hit the top, and they like stability. They don't want the dollar euro, pound going up, up, and up. They don't want the dollar going up, up, and up either. So stability is like one of the most important things in the financial world. And so as they came up near the top here, it was very likely that whatever was happening, the Fed talk was going to change to more negatives for the Eurozone and more positives for the US. And just if you watch that, you'll see that's very consistent. And there's a lot of reasons for that, which include, the very shaky derivatives game, which if the banks lose, get too much instability, I should say, the whole house of cards could come falling down. So they're really sensitive to that. All right, so that's that. Let's come back to the 5-minute and see what's happening right now. This gives us a chance. You see the trend is advancing right here again. Let me see. Look at the trend, the balance of money on the 30-minute, and then drop down to 5 to see if the sellers are making a new move, and they are. And the first thing we would do is look at the strength of that advantage. It's still shaky, still weak rather, at 14, but you can see the push, pullback. And here you've got the advance taking place. I wouldn't say that there's a new seller advantage unless you get at least a 5-minute candle close out of there, and you're not getting that. And I'm not the only one who sees this. That's why you're seeing all this going on right now. Now let's pop over to the pound. The pound actually dropped down in lower time frames all the way up through here. There just really wasn't even a 38.2 pullback of any significance, and it shows you how bullish this is. And this is a 142 pip move, and that's all pretty much since London Open. So they're continuing to buy based upon this unlikely exit from the European Union. Does that really is that really what's reflect the value of the pound? Probably not. Now, long term, I think the UK is making a lot of right moves. And I'm talking, when I buy long term, I'm talking 15 years from now. They are preparing their children better. they're doing all the things that us parents in the U.S. wish we would do in the U.S., like start training our kids on computer coding, in the 5th grade, or the 1st grade, stuff like that. They're actually planning for the world tomorrow, preparing their kids for the jobs that are going to be there 10, 15 years from now. And so they're making a lot of really good decisions over in the UK that's going to end up resulting in them probably stacking up pretty well in the global economy. But looking at this just in terms of price, you see this anytime you see it only retracing 23.6, it's very bullish. What you could watch for, and the advances are likely to be weak, is a change right here, a 5-minute close above this level, or it's stretching out to 18 or better here. You probably won't see 18 or better on advance here, just for a couple reasons. One is the heightened uncertainty, which creates more of a mix in terms of buyers and sellers. And the second thing is we're coming into about 1 hour before London closes, and London is where a tremendous number of Forex transactions are executed. Move that out of the way. So, what's more likely as we get closer to 11 a.m. Eastern is for these buyers to take profits, close out, and head home, right? So that's an important factor. But they could make another move. We'll see. Let's see. On the way up, there was no meaningful pullbacks, as I said, so there was really not much of a way to trade. The trend turnover, one of the things you might have looked at is right here. You can see this level. Right here, it ends up being there, and then look for a change right at that level. And so you get it right there. It does pull back a little bit, but you get it right there. Actually, as I saw this pulling way down here, I might have hesitated, and I would have actually ended up going with this level right there. And when you see it, when it comes through this one, it really shoots, and have the bus leaves the station without moves over 50 without stopping. So that would have been a kind of a tough one to catch. So, I mean, in a nutshell, these are not great, consistent, steady types of moves that we're used to, that we like. There is increased uncertainty in the market, so this creates a little bit more unusual behavior. And if you've been doing this for a long time, it's really easy to spot the unusual behavior. And the reason why that's important, by the way, guys, is your ability to anticipate what's likely to happen in the future depends upon repetitive human behavior. And unusual, the word unusual, represents the idea that this is not typical repetitive human behavior. So when you hear me use the word unusual, that just says low probability. That means if something unusual is happening, the information you're getting does not allow you to make a good logical decision, right? So that's the way this works. I guess that's about it for now. That's our start to the week. Hopefully we'll get something a little stronger. I doubt it. We're headed, we're at the end of May. We're headed in June. There's going to be one more trading month before things start to do their wonky things in mid-July and August. August is almost always very slow. But we should have one more good trading month before everybody unplugs. So we'll see. That's it for now. You guys have a great day. I'll plan on being back here Wednesday. That's tomorrow morning. Sometime around this time. You guys have a great one.